In this video, I'm going to talk about the modified internal rate of return. The modified internal rate of return is the rate of return or discount rate that equates the present value of all outflows with the future value of all inflows. So basically, when you're looking at a capital budgeting project, you take all of the positive cash flows, you find the future value of those, you take all of the negative cash flows, you find the present value of those, and then what you do is you find the discount rate that equates those two total amounts. So basically, the way I've summarized that here is you carry all those positive cash flows forward to the end of that last year using the risk-adjusted cost of capital. So you're kind of assuming you're reinvesting those cash flows at that risk-adjusted cost of capital rate. Then you carry all the negative cash flows backward to time zero. And then you find the interest rate that equates those amounts at time zero and at the end of the project, makes it balance out to a net present value of zero. Now, really kind of what's happening here, and the reason why we care about the modified internal rate of return, is this is an attempt to kind of correct the problem associated with the internal rate of return. So the problem with the internal rate of return is that it assumes that when I get a cash flow at the end of the year or period or whatever frame of time we're working with, that we reinvest it in an identical project to the one being analyzed. Well, that could be a bad assumption. If I have a highly unusual project with really phenomenal returns, it may be very unusual and unlikely that I would take cash flows that I receive from that project and invest it in another project that is equally amazing and unusual. What's more likely is that I take those cash flows and I reinvest it in a more normal or typical project. So the MIRR says, okay, we're going to take that cash flow that you get at the end of year one, and let's say it's a positive cash flow. I'm going to assume that we reinvest it for the rest of the project in a normal project, getting that risk-adjusted cost of capital. So basically what you do is you find the future value of each of those cash flows that are positive, and basically what you're saying is you're reinvesting at that risk-adjusted cost of capital. And then once you've got all those future values and you've got all the present values, you find the rate that equates those two and results in that net present value of zero. So in effect, the modified internal rate of return is kind of a combination of the rate of return generated by the project, because that's what's producing these cash flows, but it's also invoking the rate of return that's normal given the risks, that risk-adjusted cost of capital. So the modified internal rate of return is partially based upon that normal rate of return, partially based upon the return generated by the project specifically. And so it winds up somewhere in between the two. So when you are looking at the modified internal rate of return, it will always be between the internal rate of return, which you can think of that as being the rate generated by the project, and the risk-adjusted cost of capital. So if I'm looking at the internal rate of return, I'm looking at the risk-adjusted cost of capital, the modified internal rate of return is going to be somewhere in between. And that's an important thing to kind of note, because if you get a modified internal rate of return that is not in between those two values, it means something has gone wrong. Now, the nice thing with the modified internal rate of return is that you assess it or analyze it using the exact same rules that you do with the internal rate of return. And that is, if the modified internal rate of return, the rate of return generated by this project, making the assumption that we reinvest cash flows in normal, typical projects, if that MIRR is higher than the hurdle rate, whatever that risk-adjusted cost of capital is, project is attractive, we should accept it. If the MIRR is less than that required rate of return hurdle rate, then the project is unattractive and we should reject it. If the MIRR is exactly equal to the hurdle rate, then essentially the project is neither attractive nor unattractive, and we are in effect indifferent to the project. So to kind of demonstrate this a little bit, let's take a look at Excel, and this is kind of following along with the example that I've been using for some of these capital budgeting videos. So if I had this set of cash flows up here, if I wanted to find the MIRR, what I could do is I could find the future value of this cash flow as of the end of year 5. Now, let's kind of go back to this cash flow first. This cash flow is happening presumably at the end of year 5. So $1 at the end of year 5 is worth $1 at the end of year 5, which means I don't have to do any time value money calculation with this cash flow. It's already valued at the end of year 5. This one I would need to take and essentially reinvest it for 1 year at that normal required rate of return. So I would find the future value. When I do that, the rate would be that normal risk-adjusted cost of capital. The number of periods would be 1, because 1 period to go from 4 to 5. the initial amount would be the 50, solve for future value, and I would put that here for the future value of that cash flow. Then to repeat the process for this cash flow, only in this case, I would have 2 periods. So I would reinvest it at the risk-adjusted cost of capital for 2 periods, and I'd find get the future value as of the end of year 5. I do that for this cash flow and this cash flow. This is negative, and it's in time 0 to boot. So negatives are supposed to be in time 0. This is already at time 0. So I would just leave that one alone. So what I would have is a summation I would do here at the end of year 5 of all of those future values at the end of year 5, and I get a number. And then I would have this negative 100 over here at time 0. And basically, I would do another time value money calculation where the negative 100 would be my present value. My future value would be the sum of all those future values at the end of year 5. N would be 5. Then I would solve for the rate. And the rate that I would get would be the modified internal rate of return. Now, having said all of that, if you're using Excel, there's a formula for this. So let's take a look at that formula for Excel. So MIRR. Now, first off, before I do this, let's pause and think for a moment. I stated a moment ago that the MIRR should wind up between, has to wind up between the IRR and the required rate of return. So here's my required rate of return that I've been using in this example. Here's my IRR. So my modified internal rate of return had better wind up somewhere between 10 and 19.64%. So let's go ahead and see what we get. So the function in Excel is equals MIRR, open parentheses, is asking for values. So in this case, I am going to highlight all the values. When I did the net present value, you do from 1 through the n, close the parentheses, and then your 0 goes outside the NPV function. But for the MIRR and IRR function, all the cash flows go in there. All right, so I've got the values, comma. Now, Excel allows you to do a finance rate and a reinvestment rate. So it allows you to have separate rates for essentially your cost of funds and also what you can reinvest in, which could potentially be handy for calculation purposes. But for our purposes, basically in this video, what I'm going to assume is that the finance rate, our cost of capital, is going to be our reinvestment rate. Now, there is a little bit of logic to that that I'll come back to in a moment. So I'm going to assume that the finance rate, that was our risk-adjusted cost of capital, and our reinvestment rate are the same. And I close parentheses. And again, if I did this right, I should wind up be between the risk-adjusted cost of capital of 10% and the IRR, which was 19.64. So sure enough, I'm at 16.05. That is between the IRR and the cost of capital, which is what we expect. And you analyze this the same way you do the IRR. So the MIRR is over 16%. The required rate of return is 10%. We like the project. Okay. Now let's talk about that assumption of the MIRR that assumes that I'm reinvesting in a project that's getting that normal required rate of return. So let's suppose my normal required rate of return is 10% for this given level of risk. What if I had some projects at the same level of risk that were offering 50%? Well, I mean, obviously, if it's the same level of risk, I mean, I'm going to want to do the project offering 50% when I only require 10. So I'm going to do that project. What if it was only offering 20%? Well, I should have done that at the drop of a hat. How about 15? I should have done it. 13? Should have done it. 11? Should have done it. 10 and a half? Should have done it, right? So really, if there were any really phenomenal projects that were out there, I should already be doing them. And what that means is that the projects that I have sitting around available for me to do right here, right now, probably have a rate of return that's really pretty close to that required rate of return. Because if it was really, really good and way above that, I should already be doing it. So that's why when the MIRR assumes that I reinvest at the cost of capital, it kind of makes a certain amount of economic sense. I say economic sense in the sense that people have incentives to do all these projects if they're really providing a return that's much higher than required. So from that standpoint, it kind of makes logical sense that the project that's available for me to invest in is not one of those amazingly good projects. It's actually kind of typical in getting the required rate of return. So that's why when I did the MIRR function and it had the ability to have a finance rate and reinvestment rate. Well, the finance rate for sure is going to be that risk-adjusted cost of capital. But I use that risk-adjusted cost of capital as the reinvestment rate as well, basically because we're assuming, or at least I'm assuming in the context of this video, that due to the fact that we would want to pursue any projects that were like really amazing, probably the projects that we have sitting around available for me to invest in are just barely providing that required rate of return. So that's why I use the same finance rate and reinvestment rate. And again, lo and behold, that MIRR landed between the IRR and that required rate of return, which is good because that's what we indicated should happen. All right. So ultimately, again, if the MIRR is above whatever that required threshold is, we like the project. If it's below, we do not like the project. And if it's exactly equal to the hurdle rate, the project is neither attractive nor unattractive. All right, hopefully this little video about the MIRR and how to calculate it has been helpful. Thank you so much for watching and have a great day.